Hi, it's Ian Coleman from PIA First. I'm going to do a medium-term report forecast on dollar Swiss. Briefly going to talk about the dollar index. If you've looked at some of our previous videos, you will have already heard what we're looking for in this basket. We're expecting a move up to this Fibonacci confluence area, okay, which is 102.11, 101.95. Currently trading around 10022, broken that that big figure. Would expect dips to be bought into this week as we push up towards this very important zone where we'd expect at least a correction lower. Now, reflecting that back basically onto the dollar majors, euro dollar, I'm just going to briefly talk about this. We're expecting a push further down, 102, and then to this parity level. Most of the time we can look to dollar Swiss and say that we're -1 correlated, or we used to be able to say we're -1 correlated when the euro Swiss had a floor at 120. Obviously we've lost that correlation since Swiss National Bank pulled the floor, and we've now got some interesting levels in the dollar Swiss. Now, we obviously had a very aggressive sell-off when we saw Swiss National Bank pull that plug, and we've basically retraced virtually all of those losses, those aggressive losses from January. So if we break down, obviously this is the trend line we're talking about, so we've got this trend that's held 3 times, and normally if a trend's going to break, it will break on the 4th occasion. So we are wary of that. But then if we also break it down into a weekly chart, you can see that we've had 8 weeks of net gains since that aggressive sell-off. Now, there is something called a rule of 9. The rule of 9 dictates that you won't get, or if you get 9 same coloured candles in a sequence, then the next candle should break the sequence. So at the moment we've only got 8, so there is scope for another up week in dollar Swiss. But if we break down to shorter time frames, so if we go to the daily chart, we can see here we're now getting into overbought territory. We've broken the 161.8% level. Now we've ended up with this change of sentiment, if you like, from last week. It was actually last Thursday. Wasn't quite a bearish outside day, but it wasn't a million miles off. Okay, so the start of the week is going to be very, very important, how the market's going to react, or how the dollar's going to react to this trend of lower highs. Basically, if we break Friday's high, then we'd expect a push further up towards 105, the figure, to complete this cycle before a corrective move to the downside. However, if we break it down into the 4-hour chart, these are just naked charts, vanilla charts, we haven't got any oscillators really or indicators on here, we can see that we've got a bearish outside bar from the high, and that was actually met with quite a high tick volume as well. So there is scope that this could be the top for dollar Swiss. We've also extended to a 423.6% Fibonacci extension. However, we are trend followers, so we do need to look for some confirmation of a trend reversal. We've got bespoke support coming in at 10035 and then 99.70. We really need to see a break of both of those levels to confirm a downward bias, and obviously the first level that we're going to be looking to is 98.33. So it does offer reasonable risk reward, probably get a stop in of about 50 points. We really want to see a confirmed turnaround in this strong reversal trend before we trigger shorts this week. Like I said, a break of last week's high, and we'd look to that 261.8% level. So a bit of a mixed bag, basically a trader break recommendation this week. and this candle here being the break candle. Okay, good luck, and I'll speak to you again soon.